So I'm Marty Sakata, and I run the Ivy Family Office Network, and we do a variety of live events, online events, and podcasts. And so today we're interviewing Sarah Solomon and Nick Marcola from YourCapital, and I'm going to ask them each to introduce themselves. So why don't you guys start?
Thanks, Marty, for having us. My name is Sarah Solomon, and I'm the founder of YourCapital. Very briefly, my background is that I was an investment advisor for several years, including spending time as an investment advisor at Morgan Stanley for ultra-high net worth individuals. Prior to that, I was an engineer for several years, building large-scale systems. Academically, I have an MBA from Wharton and an undergrad in computer science. I combine my engineering as well as my investment advisory background to found YourCapital.
Great. Thank you, Marty, very much. Thank you all for taking the time to listen to us. My name is Nick Marcola. I'm the Chief Investment Officer of YourCapital, and I have a background in banking, fintech, and direct investing. I spent many years on Wall Street working at some of the largest financial institutions such as Citigroup and Bank of America. I also built and ran investment research for a multi-family office / private bank, also venture partner investing in startups. In terms of educational background, I hold degrees in accounting, an MBA in finance, and master's in financial engineering from New York University. In essence, I bring to YourCapital investment and startup experience.
Fantastic, great. So what is YourCapital?
So YourCapital is an intelligent investing platform, Marty, for those individuals who self-direct their investments and do not relinquish control of their assets. And yeah, you heard it right. It is for those who call themselves DIY investors. So the idea of YourCapital is it's an intelligent platform that has high quality, in fact, fiduciary level guidance built for free on top of the platform, so that no matter how financially novice our users may be, they're able to achieve their investment objectives. So my aha moment for YourCapital came when, as an investment advisor, I found my friends and extended friends and other people coming to me. They were managing their own money. They wanted guidance, and then they'd go to a TD Ameritrade and E-Trade to implement that guidance. And I realized that by leveraging the power of AI and machine learning, you can create an intelligent platform that connects the dots for these do-it-yourself investors, the same way that I, as an investment advisor, was connecting the dots for our wealthy clients. And that really was the genesis of YourCapital.
So how are you guys different from Robinhood and other robo-advisors like Wealthfront and Betterment?
We're actually very different from both Robinhood and Wealthfront and Betterment. For example, Robinhood is a trading platform for millennials. YourCapital is an investment platform for millennials. Wealthfront and Betterment are for folks that want their money managed. YourCapital is for folks that want to manage their own money. Let me just delve a little deeper in comparison to both. For example, in Robinhood, it attracts millennials who want to trade stocks and options for free. This is all they do, just trading stocks and options. YourCapital will have that capability of trading stocks and options, but we are for folks that want to manage their investments. They're looking to also invest in mutual funds, looking to invest in bonds, looking to invest in exchange and traded funds, and also for those looking to have a layer of oversight or suggestions for a fee who self-direct their investments. In terms of Wealthfront and Betterment, as I said, these are platforms that help people that manage money for investors. Based on research, most of the Americans are not comfortable relinquishing control of their assets. They actually prefer to manage their own money. So YourCapital, instead of directing investments for investors, we provide tools and solutions that they can make educated decisions on their own and still self-direct and keep control of their assets.
So can you talk about YourCapital's target market?
Sure. Our target market are do-it-yourself investors who currently self-direct their investments through traditional investing platforms like E-Trade, Fidelity, and Schwab. These are mainly millennials and, to a degree, some Gen Z investors who have accumulated enough capital to invest on their own. These are typically investors who are looking for performance, but they dislike paying high fees, and at the same time, they have a degree of distrust toward wirehouses and brokerage houses. That's why they keep control of their own investments.
Great. And can you talk about the demographic of this DIY investor?
Sure, Marty. So as Nick mentioned, our target market are these individuals who are young, tech savvy, smart, educated, and these are people who prefer to manage their own investments and do not relinquish control of their assets. These are individuals who are in white-collar jobs, working all across America. They have money to invest and open a brokerage account. They get 401k from their employers, and what they do is they change jobs every 2-3 years, which means they have to roll over their 401k into an IRA and figure out how to invest that cash. So just to put some numbers, over 82% of the people between the ages of 25 and 34 consider themselves do-it-yourselfers and manage their own money. When you look at the next age cohort, which is the 35 to 44, over 75% of the people say that they self-direct their investments. And another way of looking at it would be to look at the demographic, right? So even those are in our favor because we are going after these young, wealthy millennial investors. Just in 2019 alone, there were over 72 million millennials in America. So hopefully this gives you some color that demographically as well as overall behavior-wise, this is a very large and unique market.
Fantastic, great. And so what unique problem are you trying to solve for these DIY investors?
So, Marty, the thing is, while these guys are smart, educated, and well-paid, the thing that they lack is they lack access to sophisticated, financial knowledge and tools. So what these guys do when they're seeking guidance is they're very comfortable going on Google and looking for best funds, or they'll go and ask their trusted friends and family members for guidance. In fact, that's how I realized how big of a problem this was when people were coming to me and asking me for guidance. And I'm sure, Marty, your audience can realize that searching Google or asking friends and family is not a very disciplined way to invest. And even when this target market puts in this much time and effort, they still end up making subpar decisions, like staying in cash longer than they need to. And as you know, cash doesn't even beat inflation, let alone generate any return. The other mistake we've seen these guys make is invest in very high fee funds and lose money to high fees. So what YourCapital will do for this target market is save them their time and effort, help them avoid these fees, and lastly, and most importantly, help them invest their money in a very disciplined way. Once again, just to put some numbers around it, over $5 trillion is sitting in money market funds, which is cash, as of today. And when you look at how many people own a mutual fund, according to ICI, over 100 million Americans own a fund, and the average fees they pay for these funds is 54 basis points, and this doesn't even include advisory fees. So once again, the objective of YourCapital is to help save people time and effort, avoid them these high fee funds, and help them invest their money in a very systematic and disciplined way by bringing the best practices of portfolio construction at their fingertips.
Sure. So can you talk a little bit, maybe take a deeper dive into the market size? I think Nick has some insight, and also what steps you're taking to solve these problems. Because I imagine that historically the private banks and wealth managers are heavily centralized in big cities like New York or San Francisco. But I think now with COVID, we're seeing a lot more decentralization of workers. So talk about how YourCapital solves that issue, and also any more demographic information you may have.
Sure. So in terms of the market, it's actually a very large market. There's over 60 million Americans who self-direct today, whether they do it in taxable or tax-deferred accounts. So if we, not doing our analysis and research, we looked at total dollars in brokerage accounts, 401ks, IRAs, and 529 plans, and the total is north of $21 trillion, which is our total available market. In terms of serviceable available market, looking at just brokerage, IRAs, and 529 assets, those assets are somewhere around $12 trillion with a T. And in terms of problems that Sarah mentioned in her previous answer, how do we solve these problems, and what do we exactly do for folks, whether they're in big cities or scattered throughout the country? We really do 4 things using proprietary code. First, if we perform overall portfolio health check, which is to help investors validate the decisions they've made in the past, or the right decisions, or guide them in the right direction. Second, we show hidden fees and recommend less expensive options. So in this example, we show, if they're already invested, we show comparable investment that probably have lower fees or lower volatility or so. Third solution we provide is we provide comprehensive financial picture. If investors have multiple accounts and different firms like E-Trade or Schwab, if they have taxable and tax-deferred accounts, it's really hard for them to understand what is the total in terms of assets they have, and then understand the total financial picture. With YourCapital, we'll be able to log on at 3 o'clock in the morning or 5 o'clock, or whatever it is, and figure out the total of assets they have. And the fourth solution we provide is optimize their portfolios. In a concrete, for example, a lot of folks stay in cash, and by staying in cash, they're not preserving their purchasing power, and they're definitely not beating the rate of inflation. So there'll be alerts and tools in place to alert them what they could possibly do with that cash, and deploy it to a degree to either preserve purchasing power, or at the very least beat the rate of inflation.
So can you talk to me a little bit about your past efforts for partnering and growth, and what you've done and how that turned out?
Absolutely, Marty. So we have put together a phenomenal team. We have, as Nick mentioned, already a product that has over 70,000 lines of code that offers unprecedented level of guidance to people who self-invest today. So there's definitely a product that's right there. And then on top of that, we've had over 2,000 people signed up via Google Marketing, which was direct to consumer. And on top of that, what is even more exciting for us is that we have had companies as diverse as Salesforce and Pace University both excited to distribute YourCapital to their employees. So when you have a for-profit company like Salesforce and a non-profit like Pace University both see the value of YourCapital, you can see how large our market is, and why we are so confident that we'd be able to get 1 to 5% over a 5-year period. So, and we are just getting started.
So it looks like you guys have done your homework. You built up a business case. Nick, you're a partner at Venture University and a former head of research at a large multifamily office. You see a bunch of fintech deals. What do you see as the differentiators in the space, and where does YourCapital fit in that segment?
Yeah, as a former head of research, as a venture partner, I see a lot of deals, and I see a lot of deals in the fintech space. And candidly, I think there's really 5 key differentiators that firms need to have, or startups need to have, in order to succeed. One is embrace of data, because data currently is probably could be perceived as the new gold or new oil. So the companies that embrace data will do quite well. Second is automation, digitization, and use of technology to scale. Anything that could be done using technology to eliminate friction and drawbacks. So automation, digitization, and use of technology will be very crucial for companies that are looking to disrupt or succeed. Third is the size of the market. Company looking to succeed needs to go after the market that's sizable, so sizable TAM. And the other component here is embrace of a platform approach as opposed to a single product or single solution. Tastes and preferences change very rapidly, so embracing a platform approach, in my view, is really important for a startup to succeed. Another key differentiator is incorporating machine learning and artificial intelligence to actually predict and anticipate human behavior. Humans are emotional, sometimes we're unpredictable, sometimes we make decisions that we regret. So incorporating machine learning and AI to predict and anticipate human behavior will actually differentiate companies that succeed from those that don't. And lastly, or the fifth differentiator is we live in a day and age where large financial institutions actually do not enjoy great customer loyalty. So startups that have, and fintechs more specifically, that have solid business concept, great teams in place and execute well, will be able to come in and take market share from large financial companies that do not enjoy great customer loyalty. And in terms of fintech specific, I think there's really the two categories of fintechs. You can categorize fintechs into fintechs that are building solutions for existing companies or for the incumbents. And the second category is fintechs who are offering financial services and financial technology. So YourCapital fits perfectly in the B category, the one offering financial services and financial technology. But I would make an argument that to a degree, YourCapital fits in the first category, providing solutions for the incumbents, because large players, for example, like Goldman or PIMCO or BlackRock, could use YourCapital as a solution to distribute their products. I'm actually very excited about YourCapital because it fits the 5 differentiating factors for startups, in my view, that need to succeed, and it really covers well, both categories of the fintech space. I'm very excited to be part of this journey, and I anticipate that this could be a unicorn in a very short period of time.
Sure. So Nick and Sarah, so Nick kind of laid out, he set the table for like what are the things that he's looking for in evaluating a fintech firm, and he mentioned the need to be a platform. You guys have a lot of different stakeholders using YourCapital. I mean, you've mentioned the DIY set, but it's not necessarily DIY users who are using machine learning data, right? So can you talk about how you guys are going to make money? How do you acquire customers?
Absolutely. So since we are a platform for those who self-invest, we are going to make money through 5 different ways, Marty. One of them is going to be interest on cash. The second is order flows. Third is product fees. Fourth is margin loans. And number 5 is adding revenue enhancing subscription-like services such as rebalancing, as well as tax loss harvesting. These kinds of services are inaccessible to those who self-invest, and we'll charge a fee for that. Overall, we expect to generate an average revenue per user of about $120 per user per year. And if you assume an average asset size of about 100K, which is what we assume since our target market is young and they have money, this comes to about 12 basis points in revenue, which we believe is a very doable target. And I think you did ask a question.
I asked, how do you acquire and what's the cost of acquisition of your customers?
Yeah, absolutely. So we've had great success through a couple of distribution channels right off the bat. So as I mentioned, our target market are these young, tech-savvy millennial investors investing for the long term, and they're very comfortable going on Google to get their investment guidance and read articles. We've had great success doing Google marketing to get people to sign up. So that's been the first distribution channel that we've used very successfully to get customers. The second is distributing YourCapital through HR of companies. And that, again, Marty, should not come as a surprise to your audience, because we mentioned that our target market are these individuals who are in white-collar jobs all across America. So we are distributing YourCapital through HR of companies like Salesforce, Uber, and Google. The customer acquisition cost, the blended cost, is going to be in the 30s through both these channels.
I'm sorry, $30?
Yeah.
So getting a customer through Google is going to cost how much?
Well, we've had a blended cost of about 30. We have to hire individuals who are doing business development and so on. And by the way, we've already had great success with Salesforce, and the bigger the companies are that we go after, obviously the lower the cost is, because we don't have to go after that. We are not going after smaller companies. So we have a blended cost that we have for you today, which is going to be in the 30s. But as I mentioned earlier, we can easily make an ARPU of about $120 per customer.
Great. And maybe we want to look under the hood a little bit. And can you tell us a little bit more about the machine learning and AI that would be put in use from this?
So absolutely, Marty. I strongly believe that by leveraging the power of AI and machine learning, you can offer a radically different experience to those who self-direct their investments. And I know that maybe your audience has heard these terms being thrown around, but for us at YourCapital, they have a very specific meaning. So AI is artificial intelligence, and the idea there is that the platform asks users questions in a very intuitive way by using natural language processing, and understands their response as well, incorporates all that to then offer do-it-yourself investors a tailored portfolio and offer tailored guidance. So that's where the AI piece comes in. The machine learning will come a little bit later as we grow our user base, because the idea of machine learning is to see patterns in data. And by using machine learning, we'll predict the needs of our users. Most people in America buy financial products when they go through life transitions. For example, people only think about opening a 529 college savings account when they have children. So the idea is to analyze the behavior of people, say in the ages of 25 and 34, to see how often do they change jobs, when do they get married, when do they have children, and then for the next 25-year-old who comes and opens an account at YourCapital, we can then become proactive in terms of predicting the needs of such users and offering them guidance as well as solutions. And that is how, by combining AI and machine learning, you can offer a radically unique experience to this incredibly large market.
Right, so I keep on thinking about how you guys have this great distributed application, and more companies are going to become decentralized because of COVID and other things that are hurting urban areas. Mm-hmm. So you guys have this great capacity. Talk about, I know you've talked a little bit about your traction, but can you talk about the kind of assets you're looking to acquire over that 5-year period? I mean, obviously you're going to acquire a customer 1 year, you've got to retain them. There's going to be some expense in that. You're going to acquire new customers. So can you talk about that and like steps you can take towards things like partnering that might help you move along on that?
Absolutely.
Sure. So what we did is we looked at the demographics out. There's over 60 million Americans that self-invest, and we assumed that on an average they have about 100,000 in assets. In reality, between taxable and tax-deferred accounts, they could have a lot more than 100, but for purposes of our analysis, we're assuming 100,000 average assets. And if we penetrate 1% of the market, times 60 million and 100,000 K per client, that gives us about $60 billion in assets under management. However, if the average assets are north of $100,000, or if we succeed, let's say, capturing 5% of the 60 million do-it-yourself market, in that case, you could have north of $300 billion of assets. And what's very attractive, you spoke, Sarah just spoke about cost of acquisition, about $30 or so, but the LTV, or lifetime value of a client, if we assume 12 to 15 basis points of $100,000 assets basis, about $120 to $150 per year, and if you just assume for 5 years, you get into a very attractive LTV to a CAC number.
And what about partnering relationships that might help you in terms of growing the business?
Yeah, we see 3 distinct avenues where we could partner with various stakeholders. First is partnering with asset managers to have all their products available on the YourCapital platform. This is being a distribution channel for firms like, let's say, Goldman or PIMCO or Vanguard or so. Second partnering opportunity would be with firms that have sizable workforce. For example, in the state of California, there is over 2 million workers that work at firms that have over 10,000 employees. So just in the state of California, our target market will be north of 2 million users. And needless to say, there's 49 other states. So the second partnering channel will be firms, the sizable employees, where YourCapital will come in and be an employee benefit, which is technically free to the firm and helps them with the retention of their workforce. And third partnering opportunity will be with stakeholders to enhance our customer experience. And what do we mean here is partnering with firms that offer 529 plans, or partnering with firms that offer health savings accounts or insurance products, or access to premium events and entertainment, exclusive travel and leisure opportunities and so, and have them join the platform and provide value to this very large do-it-yourself segment of U.S. investors.
So I'm going to ask a question that's probably hasn't been asked before, but there's you talked about having 1% or 5% of a market share. There's an old, Peter Thiel question, and I guess it's kind of like if you had 9 different women, could you have a baby in a month? But if you had all the money in the world, like how much of this market could you capture in 5 years, and how would you use that capital to capture the market?
Well, we looked at that question from 4 different angles. In terms of clients, as I pointed out, in 5 years, we're hoping to be somewhere between 1 to 5%. We were very confident we can hit that target range. And if that's the case, we'll probably have somewhere between 600,000 to 3 million users at the very least. In terms of assets, as I pointed out previously, 100,000 average client assets. If you penetrate this 1 to 5% segment of the do-it-yourself market, we should be somewhere between 60 to 300 billion dollars of assets, and we believe that we can get to that number very comfortably. In terms of revenues, assuming the number that Sarah mentioned earlier, about 12 basis points or so, which is very conservative, because we looked at robo-advisors, for example, as a comparison benchmark, and robo-advisors typically charge somewhere between 30 to 100 basis points. So we're assuming we're going to charge about half of the lower end of what robo-advisors charge, and we could be somewhere between 90 to 450 million dollars of revenue. But realistically, we believe we can be somewhere about 175 to 200 million dollars of revenue. Yes. So in terms of comparing to the S&P 500, which is not the right comparison, because YourCapital is a high growth company and it's a startup, and hopefully we'll have a growth rate substantially higher than the S&P. But to be conservative, for purpose of our analysis, we took the S&P multiple today and slashed it in half, meaning it's 20 something today, slashed that in half and brought it down to 10x. If you assume 10 times revenue, the value of YourCapital within the next 5 years could be somewhere in the $3 to $10 billion range, which would be a great unicorn in a very short period of time. Again, to summarize in here, if we capture at least 1% of the market, which would be real comfortable, we can do that, but up to 5%, we can be a unicorn in a very short period of time and probably have a value somewhere between $3 to $10 billion.
Do you have any perspective towards exiting this? I mean, you're just starting the journey, but I mean, would you exit, to another player in the market? Are you an acquisition target? Obviously, Wall Street's going to go through a downturn at some point due to some kind of correction, and when they do that, they typically start acquiring tech companies, and white label tech companies, things like that. So where do you guys fit in that whole picture?
So Marty, while the ideal exit for us would be an IPO, as you pointed out, a lot of companies just get bought out way before that. And fintech has been a pretty hot area for the past 10 years, in my opinion. So a couple of players that have emerged in this area are, that have not only actively investing, but also buying fintech companies out, are the large financial firms, as you pointed out. And the second one that may come as a surprise to your audience is the tech companies that are becoming super interested in this space. So let me unpack each one of them a bit. So as far as these large financial firms are concerned, firms like Barclays, Citi, Goldman Sachs have venture arms that not only invest in fintech, but are then very actively acquiring them. And I mean, Goldman, which was historically being, serving very high net worth and, high net worth individuals, as well as sovereign funds, has been very active in the retail space where we operate. And they have been aggressively buying companies, sometimes right out of seed stage. So they could be a very good, they could acquire us over time as we grow. The second group of people that could acquire us are tech companies. So it might come as a surprise to your audience that Square already has a banking license, SoFi has filed for a banking license, and Google has partnered with Citi to offer credit cards to retail investors. So any of these companies could buy us out. As I mentioned, our target market are these young, tech-savvy millennial investors who self-invest, and Google is a search engine where they go to get their investment guidance. It's not out of the realm of possibility for Google to acquire a company like YourCapital, get the broker-dealer license, have the compliance be done for them, have the technology and the investment guidance be built on the platform, and then Google can use YourCapital to sell all kinds of financial products to the tens of millions of people who come on their search engine. So we believe we'll have a lot of suitors, and that's actually, frankly, a great position to be in.
So, I think it's very interesting, and obviously I think you guys are a little bit ahead of the curve in terms of that you have a working model, you've tested it already, et cetera. But I just want to know exactly how much money you're looking to raise, what are you going to do with it, and where's it going to take you?
We're looking to raise about $3 million via convert note. Of that, $1 million will help us onboard about 100,000 users, and the remaining $2 million will be used to become a broker dealer and start generating revenue. So it'll be at least enough for about 24 months, or 12 to 24 months.
But like, any closing remarks, any thoughts about this, the urgency, et cetera?
Absolutely, Marty. So as Nick mentioned, this is an incredibly large market, and the do-it-yourself market, nobody is addressing their pain points. Today, they are making very haphazard, ad hoc decisions for their investments. And so we believe that through great execution, we could be a unicorn in 5 years or less. So definitely, this is a tremendous opportunity that no one is addressing.